The market just delivered a masterclass in human psychology disguised as price discovery. While everyone celebrates new records in the S&P 500 and Dow, the real story is what happened beneath the surface, and why disciplined traders should be paying attention to the cracks, not the headlines. Here's what actually occurred this week. Tuesday brought Euphoria mechanics as indices hit fresh all-time highs. Participants extrapolated last year's gains into this year with zero friction, but Wednesday's immediate reversal revealed the fragility underneath. Western Digital surged 17% Tuesday, then collapsed 9% Wednesday. Seagate followed the identical pattern, up 14%, down 8%. This isn't price discovery. This is momentum chasing without conviction, creating liquidity vacuums on both sides. The defense sector provided an even clearer example. Trump threatened dividend restrictions, triggering immediate 5% declines. 24 hours later, military spending promises reversed those losses with 7% gains. Participants operating in pure reaction mode cannot distinguish policy noise from structural change. They're trapped in a reflexive loop, destroying capital through poor timing and transaction costs. Meanwhile, labor market data introduced cognitive dissonance that most traders cannot process. Job openings declined sharply while private hiring showed modest resilience. Service sector activity surprised to the upside. Instead of developing independent frameworks, participants defaulted to Fed watching, concentrating all risk around Friday's jobs report. This herding behavior around single data points is exploitable because it creates predictable volatility patterns. The system is revealing its structure through these contradictions. Index divergence shows the Russell 2000 gaining over 3%, while the Nasdaq managed barely 0.25%. This isn't broad risk appetite. It's tactical repositioning as capital seeks valuation relief after 3 years of megacap concentration. But the rotation lacks fundamental conviction, making it vulnerable to reversals. Sector behavior confirms fragmentation. Financials and energy led early strength before surrendering gains without credit stress or yield curve deterioration. JP Morgan and Bank of America declined 2% Wednesday purely from position squaring ahead of earnings. Technology maintained relative strength through Nvidia and Alphabet, but semiconductor subsector volatility exceeded 15% annualized, signaling unstable order flow and potential dealer hedging pressure. The bond market reveals participants pricing 2 rate cuts despite Fed guidance suggesting patience. The 10-year yield holding near 4.16% while equities set records creates a narrow corridor for risk assets. Any jobs report surprise compresses this corridor, forcing repricing across duration and equity volatility. Commodity markets are pricing geopolitical risk asymmetrically. Oil declined on Venezuelan supply news that ignores operational complexity. Silver hit records above $80 while gold approaches $4,500. Safe haven demand, persisting during equity strength, typically precedes volatility expansion. Bitcoin's 30% decline from October highs, while stocks rally, suggests crypto is functioning as a liquidity indicator, signaling tightening conditions beneath the surface. The Stoic approach recognizes these patterns without emotional attachment. Record highs on declining volume and deteriorating breadth are classic late-cycle signatures. The 17% gain, followed by 9% loss in semiconductors, demonstrates conditional liquidity, not fundamental revaluation. These moves create opportunity for those who understand order flow mechanics and avoid emotional participation. The divergence between safe haven assets and equities at simultaneous highs is a structural warning. Gold at 4,500 and the S&P at records do not coexist in stable regimes. One is mispriced relative to the other, or both are mispriced relative to underlying conditions. The disciplined trader doesn't need to know which is correct, only that the divergence will resolve. Volatility remains suppressed near 15 VX, while realized volatility in individual names exceeds 50 annualized. This gap represents mispricing and correlation assumptions. The market is providing liquidity to those who understand the difference between noise and structural change. The week's action confirms distribution disguised as continuation. New highs on declining participation, sector rotation without conviction, and violent reversals in leadership names point to exhaustion. This doesn't mean immediate collapse, but rather a regime where buying dips carries asymmetric risk. The disciplined approach is reducing exposure to momentum, increasing cash, and waiting for volatility expansion to create mispriced optionality. The market will provide better entry points for those who refuse to chase. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability. Download the complete Stoic exploiter methodology in the description because markets reward discipline, not hope.